This is Eric with Viking Analytics with an overview of the SPX market report. At Viking Analytics, we provide tools to help investors improve their risk-adjusted returns. Our Gamma Band model, shown by the blue line, since 2007 has superior returns to the S&P 500, while experiencing less than half the volatility. By focusing on risk-adjusted returns, we are hoping to accomplish both victory and peace of mind in our investments. Our lead developer, programmer, and strategist is Rob McBride, who is a former managing director of a $14 billion hedge fund. We take a systematic approach to our analysis, and all of our signals are rigorously applied and back-tested. I founded Viking Analytics in 2015 after selling a renewable fuel company. I have been in the energy business for over 20 years and have a lot of experience in commodity trading and financial analysis. In 2016, I was introduced to some concepts that helped me to understand that the options market can often be the tail that wags the dog of the stock market. And I've been publishing delta and gamma signals since 2017. I like to say that I was gamma when gamma wasn't cool. Nowadays, gamma is everywhere, and it has become common knowledge that options volume, open interest, delta, and gamma all have influences on the underlying stock and commodity markets. Bloomberg, CNBC, the Wall Street Journal, and of course Zero Hedge now regularly update investors with tips and tools from gamma analysis. Most of what I read in the media about gamma is not necessarily actionable for the average investor. The SPX report is designed to distill options data into actionable decisions that are both accessible and understandable. I'm going to move through this content quickly, so please pause the video as necessary to digest what I'm saying to go along with the charts. The first chart in the SPX report shows the daily expected range for the current trading day based upon options pricing. The level 2 upper and lower levels are essentially daily exhaustion levels for an upward or downward move with an 85 to 90% probability. We tend to use these level 2 signals when entering trades or exiting. Next, we're showing our Gamma Band model, which is essentially a trend-following, long-only model that relies on options data for its signals. When the value of SPX falls below gamma neutral, shown here by the blue line, then the model will reduce SPX exposure since risk is expected to increase. When the value of SPX, shown by the black line, falls below the lower gamma, shown by the red line, the model goes flat since risk is expected to accelerate. The second chart here shows the allocation to SPX in relation to the price level above. So right now we're 100% allocated here since we're above the gamma neutral level. If you go back to March of 2020, you can see when we were below the red line, as long as we were below the red line, the model had a 0% allocation. So in any case, this model has increased risk-adjusted returns by 75% by following these simple rules. The final model we're going to show compares the sentiment of speculative hot money investors versus patient, systematic, smart money in the options market. When hot money is more cautious than smart money, meaning when the red line is above the green line, this tends to be a risk-on market. We've shown in the residual sentiment index when this happens is in the green zone. So when hot money in red is more cautious than smart money then you're in the green zone. When the green line is above the red line, then the sentiment index goes into the red zone, which tends to be a risk-off scenario for all stocks. This model cuts investments in stocks to zero whenever the residual sentiment index is in the red zone. You can see the performance visually. When we're in the red zone, it's shown as a lighter shade of red for QQQ. And you can see how there's not a lot of gains because the smart money is still more protective than hot money. And we like to follow smart money whenever we can. The total returns when the residual sentiment index is in the red zone is negative since 2007. So for now, we are in the green zone, and that means full allocations or whatever allocations that you like into stocks. Again, this is just one tool, but if this tool is followed in a binary way, that green zone means 100%, red zone means 0%, then you greatly will increase your risk-adjusted returns. There are more indicators and tools contained in the SPX report, but this should give you a good idea of what to expect on a daily basis as we publish these daily reports. Please visit our website and download a sample report to learn more. Quick summary, our goal at Viking Analytics is to provide quantitative tools to help investors increase their risk-adjusted returns. SPX report distills options data analysis into actionable trading and investment decisions. Please email me with any questions at eric@viking-analytics.com. Thanks for your time and attention.